Welcome to Lesson 2, Returns, Log Returns, and Compounding. This sounds basic, but it's the foundation of everything in quant. Risk, Sharpe, drawdown, optimization, machine learning labels, even how you compare IHSG to bonds to USD cash. Here's the key idea. Prices don't mean anything by themselves. IHSG at 7,000 isn't bigger than USD IDR at 16,000. A bond price at 103 isn't better than a stock at 200. What we can compare is changes, scaled properly, returns, and I want you to remember this as we go. Most quant errors are not advanced math errors. They are definition errors. Wrong return definition, wrong frequency conversion, ignoring dividends coupons, mixing currencies incorrectly. Those mistakes create fake alpha and fake Sharpe. By the end, you will be able to compute returns correctly for different asset types, understand why compounding makes drawdown so painful, annualize consistently, handle multi-currency returns without accidentally cheating.
Returns are the language of markets. They are what you model and what you get paid on. 3 reasons returns matter. 1. Performance measurement. If you want CAGR, alpha, tracking error, or even just how good is this strategy, it all starts with return series. 2. Risk measurement. Volatility, VAR, CVAR,
Drawdown and stress losses are computed from returns, or return-like quantities. If returns are wrong, risk is wrong, and then your position sizing is wrong. Forecasting and ML. When people build ML models, the label is often forward return. Will next month's return be positive? If your returns are miscomputed, wrong alignment, wrong currency, wrong handling of dividends, your labels are garbage. The model learns noise. Teaching mindset, I don't want you to memorize formulas. I want you to respect definitions. In quant, the definition is the contract. Let's start with a return that maps directly to money. The simple return. Simple return for one period is, if price goes from 100 to 105, you made 5%. If it goes from 100 to 95, you lost 5%. Why simple returns matter? They correspond to actual P&L and portfolio accounting. Portfolio return with weights uses simple returns naturally. 2 practical details people mess up. Detail A. Price must be consistent. For bonds, you must be clear. Clean price or dirty price. Include accrued interest. For equities, price return versus total return. Detail B. Return is anchored to a period. Daily return means close to close or open to close. You choose. Monthly return means end of month to end of month, not an average of daily returns. Now compounding, this is where people think they understand but still make mistakes. When returns compound, wealth evolves like this. So over multiple periods, let's do the classic example because it teaches a life principle. Plus 10%, then minus 10%. Start with $1 zero. After plus 10%, 1.10. After minus 10%, 0.99. You end at 0.99, which is negative 1% total, not zero. This is why in finance we say volatility creates drag. Even if the average looks okay, up and down paths reduce compound growth. Now here's the insight. Compounding is not just math. It defines behavior. People hate drawdowns because drawdowns require nonlinear recovery. A strategy can have good average return and still be miserable due to drawdowns. So whenever you see a strategy pitch that shows only average return, ask, what's the compounding path? What's the drawdown? Now, log returns. This is where quant folks get excited because it simplifies time aggregation. Definition. Why do logs appear? Because logs turn multiplication into addition. If wealth compounds multiplicatively, take log on both sides. So log returns add through time. Total log return equals sum of period log returns. This is useful in time series modeling. ARIMA, GARCH often assume additive structure, risk aggregation across time, some theoretical finance derivations. But important nuance. Log returns are not more true. They're a different measurement scale. For small returns, log and simple are very close. For big moves, they diverge. In crises, FX jumps, crypto moves, differences matter. Log returns are a math convenience. Simple returns are a money truth. You need both. Let's make this practical. When should you use which? Use simple returns when you compute portfolio returns from weights, report performance to humans, want exact money compounding, simulate rebalancing and cash flows. Portfolio return for a weighted portfolio is naturally. Use log returns when you build statistical models. Aggregate returns across time by adding. Want symmetry properties and clear math. But here's a key warning students need. Portfolio log return is not simply the weighted sum of asset log returns, except under approximations. If you want portfolio accuracy, compute simple portfolio return from weights. Then, if you want a log version, you can transform it afterward. Also, remember the approximation when R is small. So for monthly IHSG returns of a few percent, log and simple are close. For daily returns, they're extremely close. But for shock days, they can differ enough to matter. This slide is one of the most important conceptual slides. Two averages exist. First is the arithmetic average return, or average of period returns. It's useful for expectation under certain assumptions. Second is geometric average CAGR, or average growth rate of wealth. This is what investors actually experience. Why they differ? Compounding plus volatility drag. A rough intuition. Even if expected return is positive, volatility lowers compound growth because losses compound harder than gains. Arithmetic mean answers, what's the average period outcome? Geometric mean answers, what constant rate matches the final wealth? For long-term investing and strategy evaluation, geometric CAGR is the honest measure. If a strategy alternates plus 20% and minus 20%, arithmetic average is 0%, but wealth goes down. 1.2 times 0.8 equals 0.96. You lost 4%. So I want to walk away with one rule. Never sell a strategy using arithmetic return alone. Always show CAGR and drawdown. Now annualization, the source of endless mistakes in dashboards. Annualized return. Best practice. Use CAGR from the equity curve, not mean times N. Because CAGR respects compounding. CAGR concept. If your wealth goes from W0 to WT over T years, annualized volatility. Classic rule. This comes from assumptions like independent and identically distributed returns. Not always true. It's a good first approximation. But the caveat, if returns have autocorrelation, common in illiquid assets, some carry strategies, SQR time scaling can be wrong. So if you're using monthly data, it's often safer to compute vol directly at monthly frequency. Sharpe ratio. Sharpe must use consistent units. Annualized excess return divided by annualized volatility, or monthly excess return divided by monthly volatility. Also, Sharpe should be based on excess return over risk-free, especially when comparing bonds, cash-heavy portfolios. Inconsistent annualization is like mixing Celsius and Fahrenheit. You can compute a number, but it has no meaning. Drawdown is the pain metric. Return tells you how much you gained. Drawdown tells you whether you would have quit. Definition: drawdown at time t equals current wealth relative to previous peak. Max drawdown is the worst of those. Now link back to compounding. If you lose 50%, you need plus 100% to recover. If you lose 20%, you need plus 25% to recover. This is why risk management exists. Not because we hate return, because we need survival. When teaching, I'd add two deeper insights. 1. Time underwater. Sometimes drawdown isn't huge but lasts very long. That kills confidence and gets strategies turned off. 2. Path dependency. Two strategies can have same CAGR but different drawdowns. The one with smoother path is more scalable and more realistic for real investors. This is where quant becomes real for equities and especially for bonds. Equity. If you ignore dividends, you understate performance and distort comparisons. For IHSG comparisons, total return can matter a lot depending on the index series you use. Bonds. For bonds, price only is often misleading because bond return comes from coupon income, accrued interest, price change from yield movement, carry and roll down effects. A super useful approximation to teach for small yield changes: bond price return equals negative duration times yield. Then add carry, coupon over yield income, and roll down if you model the curve. So bond total return is not just price goes up. It's a combination of income plus rate risk plus curve shape. If you don't have full bond total return series, tell them to start with yield changes for price effect approximation plus a simple carry estimate. Then upgrade later. Key message: use total return when you can. If you can't, be explicit about what you're ignoring because it changes the conclusion. This slide prevents huge real-world errors when you mix geographies. If you hold a USD asset as an IDR investor, your IDR return, US bond returns, plus 2% in USD. USD IDR moves plus 3%, USD strengthens versus IDR. Then IDR return approximately 1.02 times 1.03 equals 5.06%. Not exactly 5% because of the cross term. Now, the deeper practical part. You must choose a base currency and a timestamp convention. Base IDR. USD assets include FX risk. Base USD. IHSG includes FX risk. And if you use daily data across time zones, you must define as of time to avoid leakage. Jakarta close is not New York close. If you mix them improperly, you create fake predictability where none exists. So the professional workflow is pick base currency, align timestamps as of, convert prices consistently, compute returns after alignment. That's how you keep multi-geo research honest. Let's lock the full toolkit. Simple returns map to money and portfolio accounting. Compounding is multiplicative, which makes losses more damaging than gains are helpful. Log returns add over time and are useful for modeling, but they are not more true. Arithmetic mean is not growth rate. CAGR is the honest growth metric. Annualization must be consistent across return, vol, and Sharpe. Sharpe should be excess return. Total return matters. Dividends and coupons are not optional details. Multi-currency returns require base currency choice and timestamp alignment. Next lesson, we move into probability and distributions, because once you have returns, you must understand what kind of randomness you're dealing with. Markets are not normal, and tails are everything. Thanks for watching.